Hi there, Etoro. It is Monday, and that means it's time to take a look at what moved the markets last week. Let's take a look. It has been quite a strange week. It's been difficult to determine the dominant narrative. So at any point in time within the market, there's usually one dominant story that the market either believes or is working through. Whereas last week, it felt as though there wasn't any one thing that was really working its way through the market. And this was evident in the strange movements across a number of asset classes. As an example, stocks were up and the dollar was down. That makes sense. The dollar being down, in fact, was good for a number of asset classes. But we also saw that metals were up, natural gas and oil was down. At the same time, yields were still quite high. They hadn't dropped off nearly enough to justify the kind of rise that we saw in equities. So certainly quite a strange week, but let's look at what happened and not try to uncover what the dominant narrative might have been. So for the week, the markets had rebounded quite nicely after a multi-week drop, 2 or 3 week drop, as you can see here, a bit more severe within the NSDQ100, those technology companies, plus a few others. Chinese equities still firmly within the longer term downtrend, but also rebounding like US equities did. And as I mentioned before, the dollar was significantly off of its highs through last week, which is part of the reason that we saw a rally in assets that were priced in dollars. Last week also saw a few macro data points. It was a holiday in the US on Monday, Labor Day, but we saw some PMI readings, some surprised to the downside, some surprised to the upside. But probably the most watched thing were the speeches given out of the ECB and the Fed last week. Although in the end, there weren't any huge surprises. The European Central Bank increased rates by 0.75%, which was largely expected. There was a little bit of a question around how high they would go, but I think that was more or less where most people thought they would land. Now, because the ECB hiked their rate and they signaled that there's more to come, that means that the euro has finally started rising a little bit against the US dollar, and I think escaped parity slightly by the end of the week. So for those that have been watching closely, the euro dropped to below €1 to the dollar now and again through the past probably 2 months now. I'm not sure how many of you follow the macro compass. It is incredibly insightful when it comes to happenings within the macro sphere. They argue that the 75 basis point hike wasn't the most interesting piece of information that they put out there into the public sphere. In fact, it was their approach towards quantitative easing or quantitative tightening. So within the US, they've been hiking at the same time as quantitative tightening, so undoing the easing that they did through the pandemic to add additional liquidity to the pool available to the markets. The ECB instead has chosen to hike their rates, but they're also just going to leave the liquidity there for the meantime. They're not going to begin a program of quantitative tightening. This is quite an interesting approach, and it tells us what's more important to the European Central Bank versus the US Central Bank. The US has inflation within its targets. That's the number one thing that it needs to kill. Whereas the ECB is letting inflation run a little bit longer, maybe a little bit higher if it needs to, because that's not the biggest battle that they really have on their hands. They don't want their economy to collapse. And by allowing that liquidity to remain in the market, it means that there's more money sloshing around. It means that fewer companies are likely to default, and hopefully the economy will be propped up despite the fact that they are raising rates and will continue to do so. For the past few weeks, I've been talking about the housing market, and things are looking quite bad, particularly within the US, but that's not the only market where things are looking quite shaky. So you can see that there are a number of quite negative stats out there when it comes to the housing market. Things are definitely slowing down within the US. The US market was way too hot anyway, and some heat needed to be taken out of it. The question is now whether too much heat is going to be taken out too fast, and it means that there's going to be a collapse in that market. There are always lots of opinions flying around when this type of topic pops up, and there are the uber bears that are saying that, we're looking at another situation like we had in 2008, whereas there are others saying that it's just the market normalizing. We're probably not going to see something like we saw during the great financial crisis. What's quite interesting is that there are some countries that are a lot more exposed to variable rate mortgages versus the US. So in the UK, for example, you call these a tracker mortgage. So let's say you took out a tracker mortgage 1 year ago for 5 years. It means that as the rate is going up, and it's been going up very fast recently, that your repayments will be affected every time that happens, usually with a lag of 2 weeks to 4 weeks. This means that in those countries that are more exposed, prices have been dropping a lot faster than in the US. It'll be interesting to see how this unfolds. I have friends in Australia, for example, and I know that the house prices in the cities have been going absolutely bonkers for years, with slight breathers, and then continue ever higher. So I wonder if some of these countries that are more exposed might see some large-scale defaults. All right, on to the topic of energy. Energy has been a hot topic for a while now, and it seems that we are reaching a point where many decisions are being made. Lots of support is starting to be offered. So countries within the EU are starting to take action, and there are various types of action, but what we can say is that action is now wide-scale through the EU. So there is windfall tax being enacted on energy companies, and this is quite different from the way that the UK is dealing with things, and I'll talk about that in a moment. But this is just the short-term solution. What I find quite promising about this energy crisis is that there's going to be a lot of short-term pain, but it has driven people, companies, governments to take proper action over the coming years in order to make sure that this type of thing doesn't happen ever again. We're also seeing actions such as France, which has 56 nuclear reactors. They currently have 32 of them offline, and they plan to bring all of them back online by winter of this year. France has also built up an enormous store of natural gas. I think they're sitting at 92% full, and Germany has done something similar. So they are now sitting at 88% full in terms of storage levels. And so the result of all of these actions last week, all of these countries providing something of a united front, also trying to cap the price of Russian oil, is that analysts are starting to feel a lot more optimistic about the price of energy in the near-term future. So we're seeing the likes of Goldman Sachs, who make lots of predictions, and very few of them end up being right, but they're saying that the price of energy could halve by the first quarter of next year, which is less than, 5 months away. Moving on to the UK, so we have our new Prime Minister, and there have been some very interesting surprises. I've been pouring through the details of the plans that have been coming up, and the UK is now going to provide $150 billion worth of support for citizens and businesses within the UK economy. So consumer bills will be frozen at a certain level for the next 2 years. I think the level is lower than the cap that was supposed to come in October. And businesses will also get a cap on the price, but that will only be for 6 months. On top of this, the government is doing quite a few other things. For example, they're allowing more exploration of sites for the mining of oil and gas. They've got a very clever plan to incentivize companies that provide renewable energy whilst bringing the cost of that renewable energy down for the end consumer. This government's plan is quite different from what we've seen in recent iterations of UK government, and the fact that it thinks that it needs to spend money in a clever way in order to support the economy, to drive growth, to drive innovation, whilst at the same time trying to keep inflation down. And so we will get an emergency budget. The budget meeting in the UK is where the Chancellor, the person in charge of the purse strings for the entire country, lays out their plans for the near-term future. And on top of the support that the UK government has offered in terms of slashing those energy bills for consumers and companies, it is expected that they will start cutting taxes in certain areas so that businesses are supported, so that it's easier for businesses to do well, make a profit, grow, despite the challenging operating conditions. So it'll be very interesting to see what happens there, and that'll probably happen next week, potentially the week after that. Turning our eyes to China briefly. So Chinese inflation has been relatively low, but also growth within that economy has not been fantastic. So we've got a few different macro numbers through the past week out of China. Once again, the COVID zero policy within the country is a big dampener on economic activity. So I'm not sure if they have any plans to change that, but I don't see these problems going away unless they do. We've also seen a few calls out of the US government to restrict the export of semiconductors to China. In part, this is because the US wants to grow their domestic market. Right now, the undisputed leader in terms of semiconductor manufacturing sits out east within Taiwan predominantly, but also China. The US is doing this because semiconductors are so important to technology. Every piece of technology in the world has some type of semiconductors within it. And in order to be a leader within this area, they're trying to build their capacity at home. So this is one of several measures. Of course, this has hit the stock prices of certain US companies, particularly those companies that don't have an equivalent elsewhere in the world, so Nvidia being one example. And I do think that these restrictions will hit the revenue of these companies for a few years to come, but I don't think that it'll be a lasting impact 5 to 10 years out. AI is only becoming a more important component of society. There have been lots of interesting surprises in the abilities of AI recently, so DALL-E is just one. I'm sure you've seen the headlines about this AI-generated art winning the state fair. There's AI that's creating beautiful poetry based off small prompts. And so AI is no longer just within the realm of geeks. It's no longer about generating graphics for games or self-driving cars or bots that can trade stocks at incredible speed. AI is now starting to permeate many other areas of our society. AI computations are incredibly resource intensive, and it is only through creations, specialist GPUs and chips, for example, by companies like Nvidia, that are allowing this to happen at a price point that means that it can be profitable. This is one particular area that I'm very excited about for the next decade or so. I think in the same way that we saw the rise of mobile phones through the early 2000s to the late 2010s, we are now in the same phase for AI. AI has been around for a while, but it's really properly starting to take off. And now we're finding practical uses for that AI throughout different industries. All right, so what's going to happen through this week? We've got a number of different data points. We've already seen slightly weak data on GDP out of the UK, but the market is laser focused on one particular set of data points, and that will be the CPI numbers that we get out of the US on the 13th. The reason that this data point is so important is that the Fed at the Jackson Hole Symposium said that they were not going to pivot unless they saw a material change in inflation, a trend downwards, a strong trend downwards. They also said that if that didn't happen, they would continue to hike aggressively and hold rates high, potentially through all of next year. And so, if the CPI number comes in much weaker than is expected, and you can see the expectation there on screen, the market is likely to celebrate that because it will take it as a signal that the Fed will turn based on the data that it has received. However, if that number comes in higher than expected, I expect that we will see something of a sell-off. And that's because the market will see that as confirmation that the Fed is going to continue to hike and they're going to hold those rates aggressively. There is actually a lot of other interesting data coming out through the week, but that's definitely going to be the one that steals the show. All right, that's it for this week. I hope you have a good one. Goodbye.